Hello and welcome to our discussion on the split accounting. And under the split accounting, we will discuss today the accounting treatment of convertible preference share. But let us recap what is the split accounting. Split accounting is according to IAS 32 or Ind AS 32. The split accounting is applicable in case of a compound instrument, and convertible preference share is a compound instrument. So in case of a compound instrument, according to the split accounting or IAS 32, it is necessary to split the compound instrument like convertible preference shares into the debt and equity. So the value of the debt determination, value of the determination of the equity, the changes in a value of the debt and changes in a value of the equity in a subsequent date is what is explained in IAS 32. The value of the debt at the time of initial recognition is to be determined on the basis of the present value of the bond payable and the present value of the interest payable, but in both the cases the discount rate is used is the market rate for the interest without the conversion option. So that means assuming there is no conversion, we take the coupon rate as a discount rate for calculating the present value of the bond payable. The residual amount is the value of equity. So the total fair value of the convertible bond or preference share minus the value of the debt determined and as mentioned above will be treated as the value of the equity. The change in the value of the debt, now since debt is a separate financial instrument and this will be determined on the basis of amortized cost, whereas the equity, since it is not a financial instrument, the equity will continue to remain as the same value because equity is not governed by IAS 32. Now let us take an example to understand that. Suppose this is the opening balance sheet of a company, and on 1st April, on the same date, it issued 500,000 6% convertible preference shares issued at 112, and they are convertible into shares at the end of the 4 years. And here it is 6% is the rate of dividend, and the rate of dividend without the conversion feature will be around 9% higher. The 6%, the lower conversion, the rate of dividend is because of the conversion feature. And the other transactions during this period is that goods sold, whatever stock you had, you have sold that. So the split accounting as given in IAS 32 was not used by the company. So the question is, what is the effect on the profit if the company uses the split accounting and if the company does not use the split accounting? Let us put that in the Excel and understand that. So let us first put the opening balance sheet. The opening balance sheet information is given here. Capital 10. The retained profit is 35. The creditors 25. Supported by the assets of cash, debtors and stock. Cash, debtors and stock 20. Debtors 20 and stock 30 and stock 30. So that's the opening balance sheet as on 1st April 2007. Now with this information we'll get into the transactions of 2007. We'll see the income statement, cash flow statement and the corresponding balance sheet at the end of 2007. The first transaction here is the issue of the convertible preference share, 500,000 number at 6% issued at 12. So 500,000 at the price of 12, the total value comes to 6 million or 60 lakh, and 4 years term. The dividend with the conversion feature is 6, and the dividend without the conversion feature is 9, and it is convertible into 1 share, and there is no expense for this. So the first work to be done under split accounting, you have to split this value of 60 lakh into the bonds and the debenture. The value of the bond that you are going to get at the end of, so the present value, so 60, okay, is the value of the convertible convertible preference share. The present value of that is a present value of that discounted at 9%, discounted at 9%. So the present value of the bond is 42.51, and interest calculated at 60 at the rate of 6%. So we keep the interest rate all the 4 years as a fixed rate of interest. So the present value of the interest PV is equal to 11.66. So the total value of the bond, is the present value of the bond, and the present value of the interest is the present value of the notional bond for the purpose of calculating or using the split accounting. The balancing figure is the equity. So the splitting of convertible preference shares has been done by finding the cash flows. The cash flows are calculated, the actual cash flows are calculated by using the actual rate of interest or dividend here, and the present value, the discounting, is done by using the rate of interest as a non-convertible market rate of interest. So once we got the value of the convertible preference shares divided or split into bond and equity, we can do the rest of the transaction. So during the period they have issued that preference shares. So the opening cash available is 20, and you have raised the bonds and the convertible preference shares, but we'll not call that as a convertible preference share. Let us call that as a notional debt 54, and notional equity on this date is 5.83, and that's the total money raised. So in the balance sheet, once again you'll have the notional debt, so and the notional equity appearing. The balance sheet will appear, okay, and similarly the balance of the amount of the notional equity for the corresponding amount that we have determined. So issue of the convertible preference share in the balance sheet will appear not as the preference share, but will be shown as the debt and equity using the split accounting. Now the rest of the transaction is you sold the goods at 50, entire stock sold. So there is a sales, and sales is 50, and let us assume that the sales is for cash. So you have the cash sales, and cash goes up. The corresponding COGS, the cost of goods sold, the corresponding goods sold, entire stock. So the stock will no more be available on the balance sheet at the end of the year. So sales and the COGS done. Interest is expense, and interest is, we can show that to calculate the to show the interest, let us use the amortization table, because the debt is shown, has to be shown as the amortized cost, and to find the amortized cost we can take the help of this amortization table. The amortization table will tell us the expected or effective rate of interest. Effective rate of interest. The effective rate of interest is calculated on the bond value, and the corresponding cash flows. The corresponding cash flows is a negative 3.6, negative 3.6, and negative 63 point. In the last year is 63.60, negative, because you have to pay that. So the effective rate of interest is an internal rate of return, of these amount, and that comes to 9%. So that is the effective rate of interest. So the opening value of the debt, as we have already seen, 54. The effective interest will be calculated by using the effective rate of interest, and the effective rate of interest is 4.88. Let me put that. Okay, yes. And but actual coupon interest that you are paying is 3.6. So the closing value of the debt is opening value plus the effective interest minus the closing value, is the closing value, minus the coupon interest is the closing value of the debt, and the closing value will become the opening value for the next time period. So let us pull down the effective interest. The coupon interest remains the same. The closing interest, the closing value of the bonds will be 56.3. So let us do that for all the 4 years, all 4 years. So the closing value will increase once again. So this is the closing value. So this gives us an interest to be shown 3.6. But you can see that the value of the bond, which was 54, has gone up to 55.44. So therefore increase in the value of, increase in the amortized cost, is shown as an expense or as a loss, because the value of the liability has increased. But how much it has increased? It has increased by 1.28. So that is, we can see how it has been calculated, and as a result of which the debt will increase to that extent. The debt at the end of the year will be 55.44. So you have the total of expenses. The total of expenses is 38.4. So no other expense there. So we can find the profit. So profit is equal to 50 minus 34 point, so 15.12. We can also take a decision that interest is an outflow of cash, assuming that we pay the interest immediately. So what to do with the profit? If no information is given, we include the profit in the retained profit, and the cash will become, the closing cash in hand will appear on the balance sheet. No change in the capital, no change in the creditor, no change in the debtor, so the balance sheet tallies. So if you see that the profit of the company is 15.12 if we are using the split accounting. If split accounting will not be used, then the interest and the increase in the amortized cost will not be there. So what we can do is we can copy this and understand the effect here. Okay, so I'll say that since split is not there, so we don't have to show the split accounting, so this becomes irrelevant for us, and the debt and equity will not be there. The debt and equity will not be there. There will be preference shares. There will be preference shares, and the preference shares was 60 will appear as 60, and no change in the sales. I don't. Okay, and interest will not be there, so entire cash will be 130. We are not showing any interest, we are not showing any increase in the amortized cost. The preference shares will continue to appear at 60, so the profit has gone up from 15.12, profit has gone up to 20. Profit has gone up from 15.12 to 20, and the cash has no change because we are assuming uh, that the balance will be not treated as an interest but will be treated as a dividend, and the dividend is same amount 0.06. So no change in the cash. Cash remains same, cash in hand, and the dividend is a distribution of profit. The dividend is a distribution of profit, so the dividend goes down, but the profit is increased from 15.12 to 20. So this, because of split accounting, the profit has come down. Why? Because of the split accounting, the convertible preference shares has to be shown as a debt and equity, and interest on the debt portion will be shown as an expense, and the change in the amortized cost will be shown as a profit or loss in the income statement. So to come back to the to summarize, in a split accounting, if there is a convertible preference share, if no split accounting will be there, then entire convertible preference shares dividend is shown as below the line item distribution of profit. But if split accounting is used, interest will be shown as an expense and the debts will be shown at an amortized cost. So the changes in the value of the debt because of the amortization will appear in the income statement as a profit or loss. So we can observe that. Okay, so all of them together, let me see, I don't know whether it will be visible. Okay, thank you very much.